Good morning, everyone, and welcome to the JRG monthly webinar on the small employer world of compliance. We're going to do some housekeeping before we start. As a reminder, you have the ability to ask questions. If you go ahead and if you raise your hand and type your question in, we'll go ahead and address the questions at the end of the webinar. Also, as a reminder, after today's webinar, we will be sending you a copy of the webinar and the recording, and we'll also do a Word document of any questions that are asked by anyone, so you know you get the answers to what everyone wants to know about. So let's go ahead and start, and as always, we'd like to thank the participants from our partners, all the different associations and other members that we have, again, we partner with. So thanks for participating today, and we always like to remind you, if you have any ideas or suggestions for webinars, please let us know because we always want to do what you want to hear. So let's go ahead and start about this small employer world of compliance. So when discussing compliance for the small employer, the first thing we have to do is define what is that small employer. And then from there, and really from the get-go, we run into actually a lot of hoops that we have to jump through. And this is because the law will dictate the definition. So I'm going to go ahead and give you some examples on this slide. So for example, under COBRA, that's the right to go ahead and continue health care coverage. A small employer is one who is under full-time, 20 full-time or full-time equivalent employees. So you're not just looking at full-time, but also part-time to see if you hit that threshold of 20 employees. The Medicare secondary payer rules is another example. When we're looking to see whether Medicare is primary or secondary based on someone's age, we look to the employer to see if they have 20 employees. And those 20 employees mean part or full-time. There's no equivalent there. And then under disability-based Medicare, the magic number for a small employer is to be less than 100. Again, looking at full-time and part-time employees. Another example of the law is the Family Medical Leave Act. Really, if you're under 50 employees, then you're determined to be a small employer and not subject to that law. And again, when we talk about our employees, we're looking at, and we count full-time and part-time. It's not an equivalent test like COBRA is. Now, the Affordable Care Act is a whole other animal that we have to talk about because it imposes different requirements on employers based on whether they qualify as being a large or small employer. However, the law doesn't use a consistent definition. So you may be small in one instance, but large for another. So some examples. For the health care credit we're going to talk about, that is 25 employees. And again, we have an equivalent count that we have to look at. For the employer mandate, the requirement to offer coverage to full-time employees, someone who is large is 50 or more full-time or full-time equivalent employees. And then we have the requirement for underwriting purposes, a small employer is someone who's deemed less than 50 employees. Now, the majority of today we are going to be talking about the Affordable Care Act and compliance. However, we're also going to be addressing some other laws, the Section 125 and pre-taxing of benefits. Section 125 applies to any employer regardless of your size. And then ERISA, the federal law that governs employee benefits, which is applicable to private employers who offer employee benefit plans with at least one employee. So let's move on and start with the Affordable Care Act. Now, when the ACA was first enacted, the regulations issued did not differentiate in size, smaller versus larger, but they were based on the issue whether a plan was grandfathered or non-grandfathered. Now, this differentiation became of importance because it dictated what insurance reform mandates an employer's group health plan had to adhere to. And we have outlined here all of these group health insurance mandates, and I'm not going to go over each one of them. But if your group health plan right now is not currently adhering to all of those because of being either grandfathered or being something called grandmothered, then we're going to find probably by the end of 2017, you will have to comply with all of these requirements. Now, some of these mandates were gradually added, meaning that all these changes were not immediate. Some began in 2010, some kicked in 2012, and some in 2014. What I find interesting on two of these points, though, is dependent coverage to age 26, the first bullet point. Now, this is an example where, based on your size, dependent child may be defined differently. If you are an applicable large employer, someone who has over 50 or more full-time or full-time equivalent employees, you have to offer coverage to dependent children. And the law in this instance defines a dependent child as either a natural child or an adopted child. However, if you're under 50, you're a small employer, you're not required to offer coverage for dependent children, but if you do, you have to offer to all dependent children up to age 26. And a dependent child is defined differently. In that instance, it means a natural child, an adopted child, a stepchild, foster child, or anyone for which you have a legal obligation to. Also, we have another, we go down the slide a little bit and talks about essential health benefits. All small group health plans, those that are less than 50 employees, must offer essential health benefits. Well, a large employer or a non-grandfathered plan or a grandfather plan is not required to offer essential health benefits. On the next slide, we want to go ahead and talk about some taxes that were added by the Affordable Care Act, which are applicable regardless of the employer's size. Now, if you're fully insured, you may not be aware of some of these laws because many of these laws, the insurer is paying this tax, and then they're just passing it down to you as an employer through your premiums, or they may be giving you a line item on your invoice talking to you about the tax. So the first one we want to mention is called the PCORI fee. And PCORI stands for Patient-Centered Outcomes Research Institute. This was an institute that was created by the Affordable Care Act, and what it does is it researches disease and illness, and basically what is the best way to handle something. So this research center may be looking into heart attacks, saying if someone has a heart attack, this is the regimen that they should go through. Or if someone has diabetes, the best medications they should be on would be this. So that's what this research center is doing. Now, just like any research, someone has to pay for it. And who that someone is all of the employers with their group health plans. So this PCORI fee, it's applicable, it began in 2012, it will sunset in 2018, hopefully, unless the law is amended. It started out as being $2 per average covered life, and it's now up to $2.17 per average covered life. Again, if you're fully insured, you're not seeing any reporting on this tax. However, if you have a health reimbursement arrangement, which is deemed self-insured, you should be reporting on the PCORI tax. The next is called the transitional reinsurance fee. Now, this is a short-lived fee. It's from 2014. It's sunsetting this year in 2016. And basically, what this fee is, it is a reinsurance for insurers to go ahead and cover the lives of people who have gone onto the exchange, because we know it's really less healthier people who have gone to the exchange. So that means claims are up, and the insurers need assistance to help pay for these claims. So this reinsurance fee was enacted by the Affordable Care Act. Again, 3 years. It started out at $63 per average covered life, went to $44 in 2015, and for 2016, it's $27. Again, you probably don't see this if you're fully insured, but the carrier is paying it and then pushing it down to you. Next, we have something called the health insurer tax, known as HIP. And this really is a tax against the health insurance carriers. And what this tax is, insurers are taxed on the prorated portion of the premiums they collect. And we talk about it being prorated, and it's prorated on a national level. And based on the amount of premiums they collect versus overall, that's the percentage that they have to pay for this tax. Give you a quick example. Let's say nationally, all of the carriers together collect $10 billion in premiums. However, there's one carrier in the United States who collects $1 billion of those premiums. So $1 billion out of $10 billion is 1/10. Their tax would be 10% because it's prorated. Again, this tax is against the insurers. However, it is also passed down to the employers. It is for fully insured plans only, and it goes against medical, dental, and vision. The interesting thing about this tax is you may not have been aware of it. It has been going on for several years now. But based on the appropriations bill that the President signed in 2015, we are going to have a moratorium on this tax for 1 year and 1 year only. And that moratorium is going to exist in 2017. So next year, the HIT tax will go away for 1 year. Does that mean that your premiums will go down? Technically, it should, but again, based on your utilization, who knows how you'll be affected. And then finally, we have the Cadillac tax. A Cadillac tax is an excise tax, and that's all I'm going to say for about right now because we are going to discuss it in several more slides. Now, the next thing we're discussing is called the Small Business Healthcare Tax Credit. And what this does is it allows eligible small employers that offer health insurance coverage to their employees to take a tax credit of up to 50% of the non-elective contributions. Now, if you are a tax-exempt organization, that tax credit can only be up to 35%. Now, the key or the stickler with this small business health care credit is that the employer must purchase employer-provided health care coverage for its employees through a small business health option program. That's known as the SHOP. And the SHOP is only available on the marketplace exchange. So you can't go into a insurer and say, hey, just, I want to get the tax credit, so give me insurance. You have to go through the exchange to do a SHOP program. Now, what does it mean to be an eligible small employer in this instance? First of all, you have to satisfy 3 requirements. You can't have more than 25 full-time equivalent employees. So it means you're looking at part-time employees also here. The next requirement is that your employer, full-time equivalent employees, must have an average annual wage that does not exceed an indexed dollar amount. And that indexed amount for 2016 is $51,800. Again, we're looking at an average here. And then finally, as the employer, you must pay at least 50% of the employee premium. And I just want to go ahead and mention about a tax-exempt organization in case any of you are on the line. You have another requirement. You have to be an organization described in Code 501C and is exempt from taxation under Code 501A. Your tax advisor can tell you what those codes mean. So with the small business health care credit, the credit is only available for a 2 consecutive year period. And this 2-year period begins with the first taxable year in 2014 or later. So that would mean if you had claimed a tax in 2014, you could get it 2014 and 2015 and no other time. If you haven't claimed this tax yet and think you are eligible to get it, meet the requirements, then maybe you could claim for 2016 and 2017 or 2017 and 2018. The next issue we want to talk about is how do you count these employees to see if you're 25 full-time or full-time equivalent? Well, the first thing we have to mention is that we talk about the control group rules because they are applicable here. And what the control group rules tell us is that if you as an employer of your company, if that owner owns maybe some other companies, we may have to look at you in the aggregate to see if you hit that 25 employees or not. We're going to talk about the control rules in a couple more slides. I'm not going to go into finite detail because, again, these are tax laws. They can have very many nuances, and you really need to talk to your tax advisor about them. So when we're counting these full-time equivalent employees to see if you hit 25 or not, you also have to exclude any type of sole proprietor, a partner in the company, or a 2% shareholder, or any type of independent contractors. Now, again, based on the tax law, when we start talking about partners and 2% shareholders, there's a tax rule called the rule of attribution where you also may have to exclude any children or spouses who are working for the company. You would discount them as being an employee towards that 25 count. And naturally, if you're excluding them as to the count of the employee, you would also have to exclude them when we look at the tax credit. So how do you determine these full-time equivalent employees? What you do is you aggregate all of the hours of service for the tax year, not to exceed 2,080 hours in 1 year, and then you divide that number by 2,080. So my example is, if you looked at all of your employees, and for the year it was determined that everyone together worked 20,800 hours, when we divide that by 2,080, we would get 10 employees, or 10 full-time equivalents. The other thing I just wanted to go ahead and mention, we talked about the average annual wages to get to that 51,800. You basically would do the same thing. You're going to take the aggregate amount of wages divided by the number of full-time equivalent employees that you have to see what they made on average. And as promised to you, on this slide, we're going to talk about the Cadillac tax. So what is it? It's not a tax against everybody who owns a Cadillac. I wish it was something like that. It's a lot more complicated. This Cadillac tax is applicable to all employers regardless of size. And it's an excise tax on the cost of health care if that cost exceeds a certain threshold. And when we look at costs, we are talking about what the employer has to pay and the employee. So it's an aggregate cost here. Now for 2018, when this tax should be first applicable, the threshold is $10,200 for single coverage and $27,500 for other than single. So let's look at it, just a quick example. So when you look at a single employee, if the cost of both employer-employee is $11,000 in a year, that exceeds $10,200 by $800. So the excise tax would be 40% on the $800. When we're looking at the excise tax, we talked about health care coverage. So what do we actually mean by that? How is it defined? It is coverage under a group health plan, and it's made available to an employee by an employer. And this coverage would actually be excludable from income based on the exceptions in the tax code. Now, right away when we start thinking health care, we just may think, oh, medical, so that's whatever premium that I'm paying. But we have to remember, we have things out there called account-based plans where employees also can receive health care or be reimbursed for health care. So this excise tax is also going to include any money that goes into a health flexible spending account, whether it's the employer that puts it in or the employee that puts it in. All the money that an employer would put into a health reimbursement arrangement, any contributions that an employer may make to a health savings account for an employee, and also if the employee can make their own contributions to an HSA through a cafeteria plan, that money will also go to this threshold that we've talked about. So what we're talking about here is that you're going to see this excise tax, when it has to be calculated, it's very individualized. You're going to have to look at each employer in and of him or herself, because you may have one employee who has individual coverage and no flexible spending account. One employee who has individual coverage and $2,000 in a flexible spending account. So the excise tax, if it's hit, it's going to be different for those individuals. Continuing our discussion on the Cadillac tax, who pays it? Well, the way that the law is written and what proposed regulations we have on this, it says that the provider of the health care coverage pays for it. So if you're fully insured, the provider of the health care coverage is your insurer, whatever carrier you're out there using. And if you're self-insured, it could be the third-party administrator. And I stress the word could because the IRS has been looking at this for some time now, and they haven't really made the determination with self-insured plans who's actually going to pay it. But what we do know, and this is based on last year the IRS put out 2 proposed notices saying, this is how we think we want to handle this tax. Why don't you let us know what you think? So they're still looking for comments on it. But what we do know is that the employer, you, would have to determine what the tax is. You would then tell the carrier how much tax to pay. And at the end of this stream, the carrier would then pass that tax back on to you that you'd have to basically reimburse the carrier for. So the key thing I think, the most important bullet on this slide is under the Cadillac tax, there are a lot of confusing and right now conflicting rules. The IRS has a long way to go before they straighten this rule out. And fortunately, based on the appropriations bill signed in 2015, this Cadillac tax has been delayed until 2020. So it means we have a little bit more time for, one, the IRS to get it straight, and for us to get more educated on it. Also just want to go ahead and mention, in 2020, it also means there will be higher thresholds that have to be met. So let's spend a couple of minutes talking about you as a small employer and what happens if you grow. You know, maybe you're having a really great business year, you want to add some employees, and you might be a little bit afraid because you're saying, if I grow, I may have to do more compliance things. So let's talk about that. If you would grow and be what is called an applicable large employer under the Affordable Care Act, and that acronym is an ALE. An ALE is an employer who has 50 or more full-time equivalent employees in the preceding calendar year. So we always look at the previous year to see what you need to do in the current year. An ALE is required to offer its full-time employees, or at least 95% of its full-time employees and dependents, something that's called minimum essential coverage. We call it MEC. And if the employer doesn't offer this MEC coverage, and they have a full-time employee who gets subsidized coverage on the marketplace exchange, an employer could be subject to a penalty of $2,160 for every full-time employee. Along with that coverage, the coverage that is offered is also to be what's called minimum value and affordable. And again, if you as an employer, when you get to be a large employer, if you're not meeting these requirements and you have an employee who goes to the exchange and gets a subsidy, then an employer could be penalized $3,240 for each full-time employee who gets a subsidy. Now the key is, and I've tried to trigger it, because again, we don't want you to be afraid of growing your business. We hope that's what your aim is to do. But any type of tax under the employer mandate or penalty is only triggered if a full-time employee gets subsidized coverage on the exchange. So this doesn't automatically mean you could get penalized. It means you could be subject to this penalty. And still talking about growth, I think the key issue that you have to be aware of is that you may think you're a small employer, but you really may not be. And this comes back to what we've already mentioned, and we talk about control groups. Now, the Affordable Care Act has this control group provision that requires businesses having common ownership to have employees counted in the aggregate, in the total. So as I already mentioned, if you as an employer, maybe the owner of the company, has other businesses, we have to look at all of the businesses together to see what that total count is. Now, there are several different ways for common control to be established. Just because you may own another company, that doesn't mean common control exists. Common control is always based on really, again, ownership. And you can have something what's called a parent-subsidiary relationship, and this is where the parent company owns at least 80% of another company. Something called a brother-sister relationship, and this is where the same 5 or few owners and have the same amount of percentages in other companies. Affiliated services, really can't even summarize it here because it's very complicated under the tax rules. And then we have what I mentioned already also, this rule of attribution. And the rules of attribution is a tax law where it says ownership is attributable to someone who really doesn't own something. So an example would be, my father may own a company and it's really large, and I may own a company and it's really, really small. But because my father owns something big, his ownership is attributed to me because of the family relationship. So again, I get on the hook for owning something that I really don't own. And again, what we do with these common control rules, they're applied in the aggregate to determine the size of an employer. But when we start talking about the penalties that could be applicable, they are then separated and they're applied separately. So on the next slide, just wanted to go ahead and give you an example of what we're talking about. So here we've got Bob's Barbecue. Sounds good first thing in the morning. Bob has 15 employees. The owner is Bob Jones. He owns 100% of Bob's Barbecue. There's another company out there, Tasty Treats, making everybody hungry. Tasty Treats has 45 employees. And Bob also is the owner. Bob Jones is also the owner of Tasty Treats. And he owns 80% of Tasty Treats. So based on this example, it looks like Bob really owns both of these companies. So we have to put in the aggregate the 15 employees and 45 employees, and we come up with 60. So in this case, Bob may have thought, geez, I'm really a small employer for both my barbecue and my Tasty Treats. But because of the common control rules and his ownership, he is looked at as being a large employer, one that has over 50 or more full-time or full-time equivalent employees. Now, there is a provision under the Affordable Care Act, and it's called the Fair Health Insurance Premium. And this provision is more commonly known as community rating or age banded. And it provides that premiums can only be varied based on several criteria, mainly based on individual or family coverage, geographic area, age, or tobacco use. Now, community rating or age banding is only applicable to small employers. How do I define a small employer? Originally, what the Affordable Care Act said, that as of 2016, a small employer would be one that had less than 100 employees. However, this was a provision of the law that was amended in 2015, and now we know that for the purposes of community rating or age banding, a small employer is defined as one that has less than 50 employees. I do want to let you know, in case you're in any other states, that you may have companies. Each state can define this small employer size. Pennsylvania does use the small employer as under 50. They haven't increased to the 100. With the community rating, what we want to talk about, there are a lot of administrative headaches, and it's really unfortunate because what happens is when it's community rated or age rated, each employee is looked at for the rate or the premium that the insurance has to be paid for. So you may have one individual who's younger that you're only paying a couple $100, and another individual who may be older that you may have to pay $300 or $400 more than that younger person. Why I say this is an administrative headache is because a lot of employers say, see, if we want to keep everything even Steven and just pay the same amount of money for someone, can't we just average everyone's rates together? And the answer to that is, yeah, you probably could. You could make your own what's called a composite rate. But then you have to be very careful because when we're keeping it there, could we run into any type of age discrimination issues? And the answer is, yeah, it is possible. And when creating these composite rates, we have to be careful if we're an employer who's subject to COBRA, because if we've averaged everyone out and everyone has a reasonable rate, and then someone who is older goes on COBRA and their rate should really be more, we can't charge them more because the COBRA rules don't permit it. So I have here on this slide, we talk about grandmothered plans, and we've already mentioned that. If you're a grandmothered plan, you may still be composite rated by the carrier. However, you have to be advised that all grandmothering will convert to community rating by the end of 2017. So as we've already noted, community rating is eventually going to be applicable to small employers. Now, age banding is considered to be somewhat of a premium stabilization, and it is expected to bring rates down for some older employees and raise it for younger employees. Now, when age banding is complete, it's expected, these are the statistics we're seeing, that 65% of employers will probably see an increase. So some issues that the thinkers in our industry talk about, so what will you do as a small employer? Are you just going to provide health care coverage for your employees? We see some employers thinking in this way. So will you just go ahead and tell your employees to go ahead and go to the exchange? Will you just go ahead and maybe give them more money and say, here's X amount of dollars, do with it what you want. You can go buy health insurance or you can use it to buy groceries. The employees are basically on their own here. Now, many small employers, what they're doing are considering self-insurance. A Society for Human Resource Management report that just came out several weeks ago, it shows that many small employers are self-insuring, and this has increased from 13.3% to 14.2%, almost a total percent increase just from 2013 to 2015. Now, when we talk about self-insured, what we mean is that the employer keeps the plan premiums and pays the actual cost of the claims. They may contract with an insurance company or what's called a third-party administrator to design the plan, to process claims, but the employer actually pays those claims. On this slide, just went ahead and I'm sharing with you this chart that it was provided by SHRM, and the black line shows that growth over in the right-hand corner of the smaller self-insured plans that have increased over the last couple of years. So we're just briefly on this slide, we're going to go rather quickly, whether you would want to self-insure or not. And self-insuring is the same for small or large employers. You're assuming the financial risk of providing health care to employees. We know that the ever-increasing premiums and the fact that insurers will not always provide claims data when presenting pricing is a driving force behind many employers going the self-insured route. So why do it? The main issues are control. You can customize the plan to meet your specific needs of your workforce. Interest income, if you get extra money in your account or reserves, you can earn interest on it. It could be improved cash flow. You may have more money to work with instead of always prepaying premiums. And then finally, there's less regulation. Self-insured plans are not required to follow state-regulated insurance mandates, and also they're not subject to some of the ACA mandates. So there can be some savings because of the regulations. The next slide, and again, quickly over this, we talk about baby steps to self-insuring. Some employers say, well, that's a really big step. I don't know if I could go that route. There's something called level-funded premiums, where it's basically a partially self-funded plan, but it works like fully insured. Under level funded, what an employer does is they pay a monthly premium, and at the end of the plan year, the carrier looks and says, wow, you gave us X amount of dollars, and your claims came to X minus something, so we owe you some money back. Or if you go the other way, geez, we paid a lot more claims than we anticipated, so you owe us a little bit more money. Just quickly mentioning, when you're considering any type of self-insuring or level-funded premium, you have to look at what kind of appetite do you have for risk. If you're risk adverse, if you want to play very conservative, then generally this isn't the route to go. And it's a long-term game. You can't say, oh, I'm going to be self-insured 1 year and then go fully insured and jump back, because it just doesn't work that way as far as the numbers go. And then, of course, you always want to look at your financial situation. On this slide, we wanted to go ahead and mention some other ACA consideration. The first is what's called the exchange notice, which is required. This notice is required to be given by every employer, regardless of your size, to every new hire within 14 days of their hire. And what this exchange notice basically says, even if we don't offer you health insurance, there's a marketplace exchange out there that you can go to. We're going to talk about the employer exchange notice. We mentioned this on a presentation several months ago, and these are notices that you as an employer may be receiving saying, hey, you have an employee who received a subsidy on the exchange. Do you want to go ahead and appeal this determination? So again, just briefly mentioning that, but you should be aware of those. Other ACA considerations, we know that based on the ACA, the IRS has told us that we no longer can have what's called an employer payment plan. And this is where the employer can no longer directly pay for or reimburse individual coverage for an employee. The penalty for an employer doing that is $100 per day for affected individual, or $36,500 a year. There's no health insurance premium that would cost an employer that much money. Some other ACA considerations. We're going to go ahead and we will talk about health reimbursement arrangements, and the guidance is that they have to be integrated. So let's talk about cafeteria plans. Now, we know a cafeteria plan, it's not a typical benefit plan because it does not actually provide any benefits, at least not in the way we typically think of a benefit plan. It is in of itself a benefit, but it doesn't provide medical care or dental care or eye care. What the cafeteria plan does do is it serves as a type of funding vehicle for qualified benefits offered through the cafeteria plan. It's a vehicle to provide employees the opportunity to make choices between a non-taxable benefit, some type of employer-provided medical care, dental, vision, or to take cash. And once the employee has been given this choice, what a cafeteria plan does, it protects the employee from paying tax on the cash they actually do not receive. So in a nutshell, a cafeteria plan permits employees to pay for benefits on a pre-tax basis, where the employee does not pay federal tax or FICA on the salary reduction, and the employer also saves on FICA and FUTA tax. Technically, there's only one type of cafeteria plan, and that's referred to under the Internal Revenue Code as a Section 125. And again, it allows employees to choose between taxable and non-taxable benefits. However, I've heard cafeteria plans or Section 125 plans referenced in many ways. Some employers say, oh geez, I only have what's called a premium-only plan. And that's because they only permit their employees to pay on a pre-tax basis for insurance premiums. There's no other benefits that are provided. That's also called, again, premium pre-tax or POP. Or we also may have where an employer permits insurance premiums pre-tax, but then they also will provide an employee a cash opt-out if they waive the group health plan coverage. This is called a cash opt-out plan. And again, it has to be done through a Section 125. Then we have something called flexible benefits or flexible spending accounts. This is where employees can put money aside to have a spending account to help pay for or reimburse for medical expenses under a health FSA, or to help pay for dependent care expenses under a dependent care spending account. Another aspect we have is where an employer will just put dollars or credits for employees to spend on the benefits they want. Some people call this a flexible credit plan. Some call it a flexible benefit plan, defined contribution plan. Again, several different names. The key is, looks like a duck, walks like a duck, quacks like a duck, it's a duck. As long as anything's being done on a pre-tax basis, it must be done through a 125 cafeteria plan. Again, the basic premise is to give an employee the choice between non-taxable benefits and taxable benefits. The general concept of federal taxation is that all benefits provided by an employer and received by an employee is taxable unless there is an exception under the Internal Revenue Code. And the Internal Revenue Code does give us, as an employer, that exception, again, so we can give employees benefits. Whenever we give the employees these choices between benefits and cash, though, there is an old tax doctrine called the doctrine of constructive receipt. And what this doctrine says is that if somebody could receive cash but doesn't receive cash, they're still taxed as if they did receive the cash. So technically, we could say to an employee, geez, I'm going to give you this benefit. You're not going to receive the cash, but I'm still going to tax you as if you did get the cash. So what the IRS implemented, and they implemented this, years and years ago, is the cafeteria plan. So the key is, this is the only way you can avoid the tax doctrine of constructive receipt when offering employee benefits, and that is to set up a cafeteria plan. Now, if you look at the Internal Revenue Code under 125, it states it is a written plan. That means, and never really went into much more detail, but what it means is that if you are going to be pre-taxing your benefits for your employees, again, regardless of the size employer you are, you have to have a written cafeteria plan in place. Basically, the information that has to go into it is, again, the name of the plan, the description of the benefits, the periods of coverage, who's eligible to get in the plan, how can they be terminated from the plan, what happens if they leave and they want to come back into the plan. The key is here, no document, no cafeteria plan, no tax benefit. So rules clearly provide the plan must be administrative, uniform as the terms of the plan. And again, that's why it must be in writing. So you're treating every participant the same in an equal manner. Also, if you do have a cafeteria plan, you've got the rules spelled out. If you're not following those rules, you could also invalidate your plan. An invalidation of a plan or not having your plan in writing, basically what it comes down to is you're creating a tax liability. And a tax liability not only for you as an employer, but also for the employee. Quickly wanted to talk about this employee opt-outs. This is where an employer has the opportunity or can provide cash when an employee waives a group health plan coverage. It's called an opt-out. This must be done through a cafeteria plan. Now, a small employer, you've got a little bit more flexibility with your cash opt-outs than a larger employer. And a large employer in this instance means one who has 50 or more full-time employees. And this is because the IRS recently came out with some rulings saying that when you offer a cash opt-out, you may have to look to see whether you put conditions on it or it's unconditional. And again, it's more applicable to large employer because if it is conditional, then when you're determining whether coverage is affordable for an employee, you can take the amount that's done through the cash opt-out to make it easier for the employee. Whereas if it's not conditional, hey, I'm just going to give you money, I don't care if you have health coverage or not, then the affordability issue is again affected. More for large employers, but I just wanted to go ahead and address that issue with you. Finally, in our next couple of minutes, we're going to go ahead and be talking about ERISA and compliance. First of all, we know that ERISA stands for the Employee Retirement Income Security Act of 1974. This is getting to be an old law already. And hopefully today, I'm going to dispel a myth that many of you may have. And that myth is that in order for you to have to comply with ERISA, that you have to have 100 employees, or you have to have 50 employees. The rule under ERISA is that if you as a private employer offer employee benefits to at least one or more employee, then you are subject to ERISA. And you're subject in the same manner as that employer who has 500 employees or 5,000 employees. So the key of ERISA, the key issue is that it always wants to protect the interest of participants and beneficiaries who are in employee benefit plans. So what ERISA requires of you as an employer, and generally you're also called a plan sponsor, is that you have certain disclosure and reporting requirements that have to be done for the government. It also establishes standards of conduct, responsibility, and obligation, because as this employer or plan sponsor, you are also what's called a fiduciary. And then ERISA also says, well, geez, if you're not following the rules that you're supposed to, and someone, a participant or a beneficiary, has been harmed, we're going to give them a remedy. We're going to tell them, we'll make you whole. We'll make you well again. We'll fix it for you. And so, and a participant or a beneficiary can sue the plan in a federal court if it's been harmed. So what is a plan? It's any plan, fund, or program that's basically established or maintained by an employer. To be established or maintained by an employer, it's real simple. If a person can ascertain who's going to provide the benefit, what that benefit is, and who's going to receive it, then you've created what's called an administrative scheme, and you've established an ERISA plan. Another key way that you can do this is if you make, as an employer, a contribution to a benefit for an employee. Right away, that says you've established an ERISA plan. The one thing that I want to mention, and unfortunately for the people here in the office, I'm always correcting them about this. When we talk about ERISA plan, it is a separate legal entity in and of itself. It's not necessarily the medical policy you have with the carrier or a dental policy. However, those policies are incorporated into your ERISA plan. So when we talk about ERISA in the plan, again, it is a separate legal entity in and of itself. And it consists of underlying medical benefits or other types of benefits. When we talk about those benefits, ERISA specifically enumerates what benefits are subject to it. Medical, surgical, or hospital. So we're looking at health care here. Sickness, accident, disability, maybe an STD or an LTD program, a life insurance policy. We've got some other benefits it also mentions here that are subject to ERISA. Vacation, holiday benefits, housing assistance. I want to go ahead and advise you at this time, and we're not going to go into it today, but generally there are exceptions that you would not have to incorporate those types of benefits under an ERISA plan. It is exempted. If you're a governmental employer or a church employer, the statute says you don't have to comply with ERISA. Any type of statutory benefits, workers' compensation, unemployment, not applicable to ERISA. If you have a payroll practice where you give a benefit and it's paid out of your general assets, maybe you just give it into an employee's paycheck, again, exempted from ERISA. So our example would be vacation. Previous slide said vacation benefits are subject to ERISA. Well, now they're accepted because that's a payroll practice. You go on vacation, you come back and you get your paycheck. Also, some employers have sick plans where they will just pay an employee through their regular payroll. So that would also not be subject to ERISA. As a plan sponsor, an employer who offers an ERISA plan, you have 4 traditional obligations. And that's that you have to have a written plan document, you have to disclose to participants and beneficiaries information. You disclose this information about the plan through what's called a summary plan description, a summary of material modifications, or a summary of benefits and coverage. And that's what those small acronyms stand for. If you are large enough, you have a reporting requirement called the Form 5500. Currently, you only have to file 5500 for a welfare plan if you have 100 or more participants on the first day of the plan year and you're an unfunded plan. I'm kind of stressing that because the DOL just 2 weeks ago came down with proposed rules saying they want to change this 5500 reporting requirement to be applicable to every employer regardless of size. So again, you have 2 employees. If this proposed rule is upheld by the Department of Labor, you have 2 or 3 employees, you could be doing a 5500 reporting. Then you have fiduciary duties. We have a lot of other also requirements. We talk about COBRA. HIPAA stands for the Health Insurance Portability and Accountability Act. WICRA on this list stands for the Women's Health and Cancer Rights Act. We mention this because part of your disclosure is that you have to inform participants about these laws and what rights they may have under them. The key thing here is that all of these obligations and provisions, a participant or a beneficiary can enforce them in a court of law, and also the Department of Labor has the right to enforce them. So we're going to close down here by talking about laws that you need to know. There are at least 12 federal laws which specifically apply to employee benefit plans. Other federal laws may directly or indirectly affect benefit plans. Now, at all times, employers as the plan sponsor or plan administrator, you maintain responsibility for complying with any and all of the laws. So some of the other laws we could be talking about, Age Discrimination and Employment Act, if you have 20 or more employees. American with Disabilities Act, it's applicable if you have 15 or more employees. Something called CHIPRA, stands for Children's Health Insurance Program Reauthorization Act. If you have an employer health plan, you're subject to this law. And this law requires that you give employees an annual notice. So if you don't know about that notice, you may want to give us a call and talk about it. The Genetic Information Non-Discrimination Act, GINA, it has 2 titles. The first title is applicable to every employer with a health plan, regardless of size. The second title under GINA, it's a non-discrimination requirement as to employment-related decisions, and it's based on, it's applicable to employers with 15 or more employees. What about this QMSCO, Qualified Medical Child Support Orders? It is applicable to all employers who offer group health plans. And then finally, USERRA, Uniform Service Employment and Reemployment Rights Act. All employers must provide employees who either are in the service or go to the service, they have a right to certain benefits if they come back to you and are employed. So some takeaways for today before we open it up for questions. A smaller employer is defined in different ways depending on the law. So please don't get into the rut thinking, I'm only 5 employees or 10 employees. You could still be, there are laws that could be applicable to you. Don't be fooled into thinking that compliance isn't an issue because you're a small employer. Penalties exist for violations of all these federal laws that we talked about today. Key, pre-taxing of benefits must be through a cafeteria plan, a 125. You must have a written plan document for that. Otherwise, you don't have a 125 plan and you could be subject to a tax liability. ERISA applicable to private employers as long as you have an employee benefit plan. At least 12 laws which an employer has to comply with. I think we probably mentioned about 11 of them today. And these laws are not stagnant. Compliance can be required as you grow, so you have to be careful because some of the laws, as soon as you hit a certain number, you have to comply at that point. And then finally, the Department of Labor is auditing employer group health plans regardless of size, and you should be aware of that and keep that in the back of your mind. So with that being said, we are going to go ahead and open it up for questions. You can go ahead and type them in and we'll be able to see them. And at the same time, give you a reminder that our next event is Thursday, September 8th at 10 a.m. And this is where we're going to be partnering with Prime Pay, and they're going to be talking about the Department of Labor overtime overhaul. This is the new overtime requirements that amended the Fair Labor Standards Act recently, and that has to be complied with by December 1st. So we're looking to see if there's any questions, and at this point we don't have any. We'll just stay on for about another 15, 20 seconds. Well, again, another reminder, questions coming through, but we will send everyone a copy of the PowerPoint and a copy of the recording. And since there aren't any questions, you won't get a Word document with questions. But I want to take the opportunity to thank you so much for participating today. I hope you found the information helpful and that you're going to be able to use it in your everyday work life. Thanks so much and have a good one.